Welcome to the Creating Wealth Podcast, where Kyle Curtin takes you on an extraordinary journey alongside renowned multifamily real estate sponsors and syndication experts from every corner of the United States. We teach you how to harness the power of passive real estate investing and witness the transformation of your wealth building strategy. Let's create wealth together.
Hey guys, how we doing? This is Kyle from Creating Wealth with another super short form mini bite-sized episode. Today, we are going to talk about why C-class over A, B, and D. So C-class multifamily for syndication is definitely something that resonates a ton, especially with our type of community. And essentially, there's pros and cons to it, right? Just like A class, and for those of you who don't know, there's A class, B class, C class, and D class. And essentially, it's kind of like a 4-point grading system for multifamily, and in regards to area, and that type of thing. So A is typically going to be your most premium, like think of Boston, like premium luxury, like absolutely freaking pretty units. And D is going to be your most challenging. But the dynamic is there's dynamics to both of these elements, right? And I think it's incredibly interesting because falling somewhere in the middle, like B class, C class, it's everybody has a different preference, right? So there are some folks out there that, typically just go for A-class multifamily, like Boston. You're going to have, be coming in at pretty low cap rates. Like there's not going to be a whole lot of meat on the bone there, most likely. It's going to be a lot more of a, maybe do like extremely, extremely light, repairs. Trying to correct some operational inefficiencies, try and make things run a little bit smoother, that type of deal. And there may not necessarily be much meat on the bone. B class and C class are relatively in the middle, especially when it comes to value add. And one of the reasons why me, as well as many other folks out there, very much enjoy the value add strategy is because it adds a buffer. That's in a sense a controllable variable to some degree. And essentially, like, if the markets jump around, if you have variable rate debt, you're still going to have your CapEx plan and essentially, your value add component to that, to be able to hopefully, get in at a much higher cap rate, drop it down, when the refi period comes, when the sell period comes, and still be able to weather, some of those storms and still be able to cover the debt service. D class, on the other hand, is definitely the most challenging by far. Typically, some of these types of properties are ones that are many folks might not necessarily touch. It might be out of their comfort zone, to kind of paint the picture in that sense. But on the other hand, the more challenging the problems are, typically the more money that's able to be made. There might be a good amount of value add that you need to do. Some tenants that you might have to either evict or, figure something out with them, kind of change the dynamic of that as much as you can, that property in particular. And, it's definitely something that's a bit more hands-on and definitely, a bit more risky from that kind of sense. And B and C essentially lies somewhere in the middle, and it's definitely something that, like I mentioned, everybody, kind of takes a little bit differently. I definitely share the opinion out there and the kind of the investing thesis with a lot of other folks of A class not really being my thing. Because I definitely, am not the most comfortable with, especially if you're using variable rate debt versus fixed. And that's definitely a conversation for probably another short episode. I'm going to make a note of that one after. But if you're using variable debt and, just kind of carrying this thing with, probably at a lower cap rate going in, probably a decently lower spread in there, maybe in regards to cash on cash and the equity multiple there. But yeah, I mean, it might be more of a play depending on who you ask, um, for, just kind of maintaining the value of money and, definitely getting a pretty reasonable return on it, but definitely nothing too extravagant, and basically have kind of be at the market's discretion in a sense of if things continue to go well and if you're able to essentially cover your debt service and reserves and that type of thing. But yeah, I mean, I'm definitely a very big fan of the value add component, juice up the NOI, have a plan for that going in, and essentially have that extra buffer there just in case, things start to get a little froggy. And yeah, you kind of have something else that's at your advantage there. I'm kind of curious what you guys feel about, what your preference is in terms of, large multifamily, A class, B class, C class, D class. Where do you typically like to jump? I mean, the other thing as well, that's a conversation that can absolutely be had is how these different classes react in regards to, markets not going that well, potential downturns happening, that type of thing. I always think it's interesting and I hear different things from different people. Because I mean, typically with A class, I feel maybe a more, monetarily sophisticated, higher income earning tenant might be able to weather more storms like that, to continue their rent, in events of, people getting let go from their day jobs and, so on and so forth versus D class. I'm very curious how that dynamic would kind of go. But I mean, you got to think as well is you also have that, potential low income, Section 8, type of tenant that may be occupying a fair portion of the building, depending on what market you're, trying to stabilize that asset in. So, I mean, you kind of might have that going for you as well. And, maybe things won't be so bad. Where I would be a little nervous though, and this is just kind of a 10,000 foot view from, kind of where I'm at the moment, is in between B and C class, or maybe B minus and C class, where you might have a mixture of, potentially lower income tenants and, tenants that, make a reasonable amount of money, and how economic downturns would affect them in that sense. But yeah, I'm kind of curious, and I mean, these are things that you definitely want to be thinking about when you start to come across investing opportunities, whether you're a general partner and or a limited partner on something like that. It's just kind of keeping that detail in mind, you know what I mean? And it's hard to tell because nobody's got a crystal ball, but yeah, just something to think about. And that's definitely, essentially picking which of those four letters or, multiple of those four letters in particular different markets is definitely something that you want to have straightened out pretty early on. Basically, if you're on both sides of the coin and essentially, what you're comfortable with, you know what I mean? And in regards to what kind of rough forecasted return that you would prefer on, assets in those classes. And that's definitely something that you would want to have spelled out in your criteria on, assets that you're comfortable with, and something to definitely consider. But yeah, I'm very curious what you guys think about A class to D class. What do you like? What do you don't like? Pros and cons. What do you think? But yeah, I'm gonna cap this one off right now, guys. I hope everyone has a fantastic day today. Please, if you could, follow and leave a rating and a review on the podcast. Try to get, some of these conversations and interviews and things like that out to a lot more people, teach a lot more people. And yeah, I hope everybody is doing well. And I will catch you in the next one, my friends. Alrighty. Have a good one. Bye.
That's a wrap for today's episode. We want to thank you for being a valued listener of the Creating Wealth Podcast. Make sure to visit www.creatingwealth.com to connect with us. Dive into our ever-expanding library of informative blogs. Get access to our private investor portal and explore a wide range of additional valuable resources. Stay tuned for our next episode as we continue to create wealth together.